thanks again to Hamid for that really insightful presentation. I'm sure there'll be a few more questions that come out of that now. But I wanted to thank our other panelists for joining us up here today. And so what I want to do is just, feel free to ask questions throughout. If you have any questions for the panelists, we do have a microphone going around, so don't wait for the end to ask any questions. But I thought we could kind of kick off this discussion looking at kind of the impact of the global macro environment on, financing right now. And so, some of the implications for the junior sector. So how do you see, what's currently happening globally impacting investment? We'll start off at the end.
Good morning, everyone, and thank you, Hamid. It was a great keynote that kind of, I think, warmed us all up for the rest of the discussion. I don't want to turn it into a support group, which with us all crying on each other's shoulder, but definitely, yeah, there are difficulties and issues in raising money and implementing on everything that we know that is critical and that is sort of a time constraint, with the big constraint, I suppose, being the 2050 net zero global goal, and how do we get there? In exploration, which I think you alluded to, there is also a bit of optimism, and that's through technology. So we do need to discover a lot more resources, and as timely as possible. And it's very difficult for juniors to raise money now for exploration. It's just very, very challenging. Generally speaking, as Hamid mentioned, in terms of who invests in the mining sector, I actually saw a statistic that the total AUM of major funds and pension funds has dropped substantially from the previous decades going forward to this decade, including in major hubs like London and Toronto. So that's definitely an issue. But at least on exploration, where perhaps there's less risk of a disruptive technology sort of pulling the rug from under the feet of the incumbents. We are seeing companies like Virai, like Cobalt, that that have ways of exploring using AI and machine learning and mass data crunching of regional and global data, and coming up in a quicker way with actionable targets, which I think is important. So at least perhaps that part of the 15 years or whatever it takes from discovery to production, we can perhaps A, squeeze and shorten in terms of the timeline, and B, perhaps waste less time of money on false positives, or what some cynics will call lifestyle companies, and also avoid missing out with false negatives and letting a perfect resource just kind of slide under the radar. So in exploration, I think there are a few rays of sunshine there, although it really is hard to raise money, and including for fantastic assets and not just marginal ones. I think that the work here in the U.S., the LPO, the DOE, the ARPA programs, the DODs, all those sort of programs and stimulants. No, we haven't opened up 20 new mines, and a lot of those that got approved still haven't went into construction. But something did happen. The pot was steered. There's more awareness. There's still all the issues that we're facing, the trust issues between the general public and the mining industry, but there are movements. Things are starting to, I think, move potentially slowly in the right direction. It's just that these are aircraft carriers, not skateboards. So these things take time. And connecting back to what Hamid said, this is really a race against time for the human race. So yeah, so it's still a support group, but I think there are rays of sunshine, and there are things that could be done on individual company level, on bi-directional solutions to incentivize the general public to participate, on national level, on regional level, and on global level.
I I would say the biggest issue facing the exploration sector is the global geopolitics. I'm based in Toronto, the heartland of exploration, and most of the junior companies are listed on the TSX. A high percentage of them are either in Toronto and Vancouver. And I've been involved with PDAC, which is the big mining conference every year. We keep annually we keep a survey looking at the state of financing, etc. And I'll tell you, in all my years in PDAC and in the Toronto junior space, I'd say I've seen at least 3 or 4 major downturns, and it's a cyclic industry, and you always expect to see some downturns. I would say this, and I was around during the time at BRIEX, I was at Bank of Montreal at that time, so I've seen downturns. I would put this as maybe the 3rd worst. So I'd put this with around the time post BRIEX, and then after the financial crisis, gold did well, but then there was a severe downturn, and I'd say this one is number 3. Why? What has happened since the Ukraine war and since the world bifurcating into 2 halves with Russia and some of the BRICS and some of the third world non-aligned countries on one side, and on the other side, you have the US and the EU and Canada and Australia. I call that the Anglosphere. I did an article with Amy that talked about that. And what has happened now, you only have half of the available money for financing. In the old days, you had a big pot. Now you have basically half the pot, because a lot of the Asian money, and I've spent a number of years in China, aren't looking to finance junior projects within the Anglosphere. There's a lot of possibilities for projects in what I call the non-Anglosphere, which is like Latin America, Africa, and maybe Southeast Asia. But the pot of money that is available is quite small, and it's quite profound in Canada. I know it's quite profound here, and also in Australia. Australia maybe just a teeny bit better. So going forward, by the way, another point I wanted to make is that also the amount of money that was available for financing junior projects, mainly gold and precious metals, base metals, copper, etc., have now gone into the new thing, which is critical minerals. And a high percentage of the money has been going into critical minerals, but not the traditional minerals that are considered critical minerals like nickel and copper only, but lithium. And so lithium has stolen the thunder from traditional metal financing. And I just saw some numbers recently by one of the securities regulators in Canada, and lithium is way up there with gold in terms of the amount of financing. So it's a smallest pot, and then the smaller pot is going to one area mainly for financing. That's my sort of overview.
Thank you. I think what Kid just said, I couldn't agree more. In terms of geopolitics is definitely playing a role. The bifurcation and the resources are not available globally to the best, make it available to the best use case, right? Often it's politics and other factors that come into play where the money would go. I think in addition to that, of course, we have to take into account the factors that after almost a decade of almost zero interest rates, we have entered the monetary tightening phase, and this is the high interest rate is going to stay at least for the foreseeable future, meaning that not that at the rate that we have right now. Probably Fed would cut the rate a little bit, but we'll never go back to, at least not in the foreseeable future, we'll go back to the near zero that we had between, say, 2009 and roughly 2020. So almost more than a decade, we had that ultra low interest rate. And during that period, even it was difficult to mobilize resources for mining. And now with the higher interest rates, money is chasing higher return, which can be found elsewhere. So I think that is a high interest rate environment is not going to help the mining sector as much. So that's one factor to keep into account. But also, as I mentioned before, technological choices are making a huge difference. Although lithium is now the winner, the poster child of all investments, but I also hear a lot of jitters about, okay, what's next? Lithium is now the champion. They're also looking for the next winner. And that is also preventing money going into sectors where, or mining sectors where you could have good return. There's a wait and see mode among the investors, especially the large investors. They want to see the trajectory of the technology that we have at hand and where it go. So it's not a settled case yet. So I think a lot of uncertainty is playing a role here, and that is making it very hard for the juniors to get the money that they need to explore and to extract and to bring more supplies to the market. And also, if you look at, and I was trying to figure out, copper prices are rising, or it's pretty good right now. War efforts definitely help, because you need a lot of copper when there's a war. But cobalt prices are going in the opposite direction. You'd expect copper and cobalt prices to be highly correlated, but they're not. That's again, maybe there's a fear about the future of NMC, or the NMC would be the dominant technology, or something else would replace the LFP or other things. So technology also, I would add to what Keith just mentioned, is playing a role here as well.
And just one point, Hamid, I wanted to add. You talk about interest rates.
Yeah.
You didn't mention inflation. Even in the junior space, inflation is a big factor, because the amount of money you used to spend, for example, to drill 100 meters of a hole is now more than double when you go back, a decade or so. All the other additional costs is higher. So we have a higher cost environment and less money coming in.
Absolutely. Do we have any questions from the audience before we continue on? Okay. So a lot of what's driving kind of this focus on critical minerals is regulation that's coming out of both the US and globally. You mentioned Quebec as well earlier. They actually have a piece in the assay that's available here talking all about their critical minerals plans. But I thought we could take a look at some of the lessons learned from the IRA, and, has it driven the amount of change that is required, or that it helped to potentially?
Let's put it this way. In terms of stimulating the technological, sort of the mining tech ecosystem, it's definitely done quite a lot. I think it's also made a difference in terms of at least planning and approving for midstream conversion. Definitely the Electric Transportation Act, the CHIPS Act, the IRA, the new, which I guess we'll discuss later, the new Section 301 proposal on tariffs on China-based and other foreign entities of concern, materials, cells, and EVs, all make a difference. What it hasn't done yet is stimulate the upstream, and not a lot of mines have actually started and opened up, and that probably has a lot to do with with past legacy, with NIMBY, with a lot of with potentially the concept which the State Department, I think, is also, and the DFC are supporting, that actually the upstream can happen somewhere else, and the added value conversion should perhaps happen in the United States and Canada and so on. Canada is a bit of a hybrid because it's very it's also upstream friendly from that perspective. But you probably also saw that the EU is implementing now also another their Critical Minerals Act, the next version of their act, and that created some hope that they will actually start supporting the demand side through creating strategic stockpiles of some of these relevant materials. But if you actually kind of read through the various tiers and targets that they created there, their goal in terms of mining and upstream is only 10% local content. And then for conversion and for downstream, it's much, much higher. For recycling, I think it starts at 40%, goes up to 70%. For local added value, it already starts at 40%, etc. So this also sort of signals that perhaps they're kind of giving up on mining on the regional level and are assuming that through international partnerships, through other arrangements, the upstream can come from somewhere else to be processed and to sort of keep within the region the more added value issues. And this, I think, is another sort of developing and developed countries' point of friction. Because if you actually think about it, a lot of what we call the resource nationalism that created the mining law in Indonesia in 2009 and so on was based on the assumption that the real money is made on the added value and not on the mining, and that we're actually at some sort of a cost plus arrangement, sort of ripping them off and sort of in an unfair way distributing the wall-to-wall benefits, and that actually the real benefits are from the further advanced industrial activities. Which is not necessarily true, by the way. Many times, actually, you make the money on the mining, and the industry is a lot of blood, sweat, and tears kind of cost plus, activity. So it's not exactly clear, but that's definitely how these things are perceived. But that's another aspect. So maybe if you think from a global perspective, both the EU and the United States might be sending the message to Africa, to Latin America, to the places where a lot of the upstream is, but there's also an ambition to turn into a more scientific, technological society, to move from, to move into services and so on. There's a bit of a potential clash there because that again seems as sort of an unfair distribution. How exactly do we sort of overcome that friction? I don't know, but that's part of what you preach, I think, Hamid.
No, I think in terms of this reconfiguration of the supply chain, that should started even before COVID, but after COVID, you see that that all countries are, especially countries in the West, they're trying to reconfigure and reduce their dependence on China. But that has put the developing countries between a rock and a hard place in terms of what would be their strategy at this stage. And think about if you're very closely aligned with China, China brings a lot of money and technology, and they get things done very quickly, then they are shut off or they can't access the European or US market because then under the IRA or under other arrangements, if it's seen as a Chinese export directly or indirectly, that would prevent them from accessing the US market or the European market. On the other hand, if they're closely aligned with the US and Europe, then they have market access, but they can't produce anything. Meaning that they don't have the money or the technology that can really quickly, get the goods off the ground and ship it. So that's where many of the countries are now struggling, especially if you look at the DRCs of the world. They are facing a serious challenge. Like, for example, DRC has about 70 or 80% of the cobalt deposit in the world, but almost all the mining assets are China-backed, China-linked, China-owned. And then many of them are saying that if this is what would be how that be defined? Is it the Chinese export or the export from DRC? So I think rules of origin and all these other related issues would come into play, and that would make it much difficult. At an aggregate level, as an economist, what we see is that there's two effects of this kind of policy intervention in the free trade. Like you have trade creation and trade diversion. Trade creation is desirable. Like if you create a barrier to entry, like in the case of US, tariffs that have been announced, if that would create more trade for the US, meaning that US is able to export or US is able to import new things that wouldn't have existed from, say, third sources. Like if China is made more expensive, but there's a competition, a competitor to China, and they can put the goods to the US market at a slight cost advantage, then consumers benefit. That's a trade creation that didn't exist for other countries to compete with China. With the tariff on Chinese exports, now that country becomes very competitive for the US market. That can be desirable because you want to reduce the monopoly power of one big country, one big exporter, and you encourage more competition. On the other hand, trade diversion means that actually trade is diverted away and it doesn't really add new trade to the global scheme of things. And I think that's where the risk lies right now, because any kind of tariff structure that you put in place is distortion. And the changes that we are expecting to happen, the market configuration, it'll take time. It will not happen overnight. Meanwhile, we'll see less trade of the critical minerals, less supply of the minerals. If you look at the global trade aggregate numbers last year, it was the lowest trade exports and imports globally for goods in any peacetime year. Even it was lower than the exports and imports in 2009, which was a major global recession we had. So this is not a very rosy picture that we're looking at. The trade restrictions that are coming into play, in the long term, it may benefit some of the producers and other producers, but in the short term, the cost will be very high. Again, I'm not an unashamed advocate of free trade. Actually, I'm very critical of free trade. You have to have fair trade, and you have to have mechanism in place where developing countries can compete in the marketplace in fair terms. And I think this is now that geopolitics is playing such an important role. I think it will be harder for them to choose the right trading partner, right investment partner, and ultimately that would have huge impact on the consumers. The final point I would make is that obviously China has attained huge advantage over other countries in terms of cost efficiency. Their BYD EVs are 1/3 the price of the comparable cars made in Europe. So they have a huge cost advantage. And you can argue that, yes, there are a lot of subsidies given by the state, but the subsidies are everywhere. Boeing receives a huge amount of subsidy from the DoD and NASA. But we are not accusing Boeing of being subsidized, right? But so we have to think about subsidies are definitely played an important role, and that can ultimately benefit the consumers. The US also can think about, or US and Europe can also think about other subsidy measures that also can make the cost, make the products more cost competitive, not just about tariffs. Tariffs can be more distortive than domestic subsidies that you can provide to encourage, like why the Teslas will be 3 times more expensive. How do you bring the cost down so that Tesla can compete with the BYD cars from China? So personally, I feel that this trade war that is unfolding is not good news for the world economy, and it's definitely not good news for the mining sector. Thank you.
You ask about the U.S. Inflation Reduction Act, the IRA, and that act provided $300 billion for the energy transition. And in addition to that, there was the pre-existing Defense Production Act, which went back from the Second World War, which was there to support minerals and strategic minerals that could be used in wartime. What has happened is that $300 billion that is supposedly to be deployed in the energy transition, just a very, very small percentage. I don't know the exact number, but I'll dare say it's less than 2% has been deployed in the critical mineral space. And I would argue it goes back to pre-existing conditions here in the U.S. and pre-existing political conditions. In order to deploy the large amount of money into the mining space, you'll have to go against the traditional distrust for mining by the Democratic Party and the same party that put the IRA into play, because they are concerned about environmental issues. So they have a constituency that wants the energy transition, but they also have a constituency that is very protective of the environment. So here, I have this pot of money that I want to deploy, but over here, there's a group that's saying this money, if it's deployed, it will affect the environment. And we all know that there are many states in the US where, especially in the West, mainly California, where it's almost impossible to develop a mine. In addition to that, a high percentage of the money is being targeted at the downstream end. I think you mentioned that, which is essentially processing. And processing of the minerals and then the end products, but mainly the processing of the critical minerals, has been outsourced to China. China does all the processing for the last 2 decades. I used to go to a place called Baotao, which is in northern China. It's a city not too far from Beijing. And if you went there and you spent a day and you had a white shirt and you came back, your white shirt is gray. And it's from all the processing that's going on there. Everybody talks about lithium and we should have a reshore and have our own processing of lithium and have our own sourcing of lithium, for example. But the little dirty secret is that more than 70, as much as 80% of all the processing of lithium anywhere in the world, in Canada, Australia, Europe, is processed in China. Because the Chinese, over the past decades, have developed the techniques. How processing of lithium is not the easiest thing. It's like a alchemist in a room, trying this, trying that, and see that it works. And they've been able to be able to do it on a large scale with a head start of 2 or 3 decades. And they've been processing lithium. In addition to that, the environmental concerns that we have here, they don't have as much. And processing lithium, this is another dirty secret, is a dirty business, very, very dirty business. We talk about processing metallic ores and gold and copper, etc. Once you start to get into lithium, you'd see how dirty it can be. So I would say that $300 billion that's allocated, but if there's a change of government, we may not see that money spent. But I think you'll talk about what a change might mean, because I think that might be better days for the mining space in another way, and we can talk about that. In terms of the Defense Production Act, there are, I don't know if some of you heard about a recent deal, a Canadian junior company with just a very early stage greenfield critical mineral project in Quebec. They were able to source a sizable sum of money. I think it's $12 million for a junior startup. It's a nice little chunk of change under the Defense Production Act. And that is an act that, as I said earlier, was in place since the Second World War. That act actually helps finance Canada's the Sudbury Basin, which was at one time, and is still one of the world's largest producer of nickel, maybe Norilsk in in Russia and Goro and the stuff we have in New Caledonia near Australia. The only, and of course, in Indonesia. But that money was given to Canada and Sudbury to develop their nickel capacity, and that money was used to develop a lot of some of the largest nickel mines, which end up being in a lot of the tanks that were used in the Second World War. Hopefully, that kind of partnership with Canada and the US could continue under the IRA or the Defense Production Act, and have a lot of funds deployed in Quebec, but other places where there are other critical minerals that can be used for critical purposes. And we have to remember what critical minerals are. Critical minerals, the essence of critical minerals, which is a rebranding of the old strategic minerals, minerals that if my enemy has it, I want to have it from them. And if I have it, I'm not going to give it to my enemy. You know, forget all that fancy thing about critical minerals. That's essentially what critical minerals is. If I have it, I don't want to get it to my enemy. And if my enemy has it, I want to get it. And I'll.
So Keith started to talk a little bit about the political side of things, and there is an election coming up in the U.S. Later in the year. So what do you think a potential change in the administration will mean for kind of critical minerals policies and programs moving forward?
You want me to start that? Or okay. Yeah. Yeah, I'm on a road. Yeah. Well, I'll tell you, if you go back to this, let's assume there's a change in government. The new administration, the Trump administration, has always been pro mining. They like hard things. They like hard assets. That's the mindset of that administration. Anything from the ground, mining oil, mining minerals, mining metals. So I would say that actually, ironically, although that's a government that isn't pro energy transition, they're not against energy transition, but they see energy transition as one of the mix, just one of the other forms of energy in addition to fossil fuels, etc. I could see a situation that the government that is not pro-energy transition, which is pro-mining, and from a strategic point of view, looking at the world, that we should be producing a lot of the stuff here in the North American continent, a lot of reshoring. And how do you reshore? You try and extract some of the stuff that you have here in your own North American continent. And I could see them removing a lot of the regulations and environmental regulations that retard the development of mining. So I think it will be a boom for mining in general, critical minerals and the traditional the base metals.
Yeah, no, go ahead then.
So yes, I do agree with you that there's perhaps more inherent friendliness to the extractive industries in general, whatever that is. We are seeing the extractive industry itself having a bit of a Kodak moment and actually going into critical minerals. So we are seeing Exxon in Arkansas, Alabama, et cetera, focusing more and more on lithium and trying to find ways to extract lithium from production water. So it sort of gives another life to decommissioned assets that were already closed and you know at the stabilized rehabilitation phase of that. So there's an opportunity there, I think, first of all, at least on lithium and some other metals to have another round of revenues from capital that was already spent, paid for, and you know, and so that's potentially one good thing. Another angle is that a lot of the downstream is actually going to happen in what they call red states. So that's another reason probably that supports the concept that there's no reason for a Republican president to necessarily fight against electrification of mobility or anything that has to sort of do with that. And in a funny way, perhaps the fact that there might be more support to a longer transition where we still produce energy with fossil fuels. We do have ways these days to add carbon capture and carbon sequestration to existing fossil fuel power generation facilities. Actually, the conspiracy theory said of the environmentalists that if you add those units to these facilities, it will incentivize extending their life, and it's sort of a bit of cheating because what we really need to do is decommission them completely and as quickly as possible transition in full. But perhaps some sort of kind of a sunset and sundawn sunset transition period where we staple to these facilities carbon capture, carbon storage, and we make them carbon neutral. Could be could be a good idea in itself. I'm not a scientist, but it's not something that I would necessarily intuitively object. So maybe actually looking again at the half full part of the glass, a transition into a at least in theory more extraction friendly type of political arena may not necessarily be a bad thing in the long run to reaching our sustainable goals and to actually transitioning. So I wouldn't be panicked and assume that the moment if there is a change here in power in next year that it's going to make a huge transition and we'll all be encouraged to buy 5-liter cars and drop the diesel even and and so on. So I wouldn't go as far as that. What could be perhaps maybe a little bit of a negative approach from just if it's more of a libertarian kind of approach, then there is perhaps less appetite for active and proactive government intervention in the private sector and correcting course in a more proactive way, which is something that we may need. And if we're going to, if we're talking about midstream conversion, for example, and once the minerals reach the shore, whether they were extracted here or imported, and before they go into the downstream that everyone loves, it's already the product, it's the marketing, it's the branding, it's the design, and so on. There's this blood, sweat, and tears of chemical industries and and industrial activity, and over there we may need government intervention even on a level of actually building state-owned or federally owned or in some sort of a PPP arrangement facilities, because you do need some hub quickly that will process 200,000 tons of lithium hydroxide to feed the downstream. And the vertical integration that everyone, whether it's going backwards or forward, so far hasn't really increased the total installed capacity, although we've been talking about it for 7 years already. And even Corp, which I love and was one of the first to actually go there, and we invested in companies that are going to build facilities there, still hasn't happened. So potentially a more again libertarian, or any way you want to look at it, but less less open to PPP and to active and proactive government intervention and sort of intervening where the invisible arm is failing us. I think this may be a potential downside of that type of a political change in terms of approach.
Thank you. Just for full disclosure, I'm not a US citizen or a Canadian citizen or not from the Anglosphere. So I have no views personally or from the UN about the political transition in the US. But having said that, I think we have to be careful about what we wish for, not in terms of political transition, but in terms of the market, where the market is going. So the mining boom may lead to a mining glut and a collapse of prices. And we have seen that game played over and over again in the past. if you look at the fracking industry in the US, when the oil prices were 100 and plus, a lot of junior fracking companies came into the market. They said, "Oh, this is going to be a huge," because they can break even when the oil price is over $40, $45, and at a $60 or $70, they were still very profitable. But when the prices collapsed, then many of them went out of business. So I think the biggest challenge for the critical minerals sector is the price volatility. It's a huge. We have done some studies in my team. I see that average volatility of lithium prices is 3 times higher than other traditional metals and minerals. So it's highly volatile prices. At high, when the price volatility is very high, it's very difficult to invest. Very difficult. So some of the extremely risk-taking investments, they would probably bet on the price will keep going up, and so they will do that, and some of them probably win or come out as a winner on those bets. But on average, if you look at this is the casino story. On average, most of the investors would lose out when the price is highly volatile. So it's a timing that would matter a lot. So from the industry perspective, what would be desirable? It will be desirable to have steadily increasing prices, not a price that fluctuates too much, too frequently. But this is where it's literally a new market. We're looking at the lithium prices, spot prices. If you look at what happened the last 16 or 18 months, it's almost unbelievable that what happened in the price fluctuation and price collapse. It's because a lot of early investments went in, and everyone is expecting there'll be huge supply increase in supply in lithium, and that actually drove down the prices. Now, many of the lithium investors are actually, including people that we know that are not in a very good position in terms of the expectation that they had about what the lithium price would look like in 2024, 2025. Now, the downward adjustment is very painful for many of the investors because the returns were sort of adjusted to the expected price of lithium, but expected price and the realized prices are very different right now. So I think this is a word of caution in terms of political. So if market can work without too much political interference, it is a good thing. I'm in favor of regulation. Regulation can give more predictability, but if every decision, investment decision is a geopolitical decision, then chances of mistakes are very high, and there will be overproduction. There will be a lot of crowding in that is not desirable for the industry, and that may have a huge adverse impact. So the best hope for us should be, can the market stabilize for all the critical minerals that we all care about, which are critical for energy transition? We see, of course, Keith's definition is a great definition. If our enemy, but we would like to believe there is no enemy per se. So we'd like to believe non-friendly countries. But idea is that we want to have the critical minerals because they are critical for achieving our energy transition goal, our goal of achieving net zero by 2050 or even sooner. Thank you.
Yeah. One point Hamid just said, which I totally agree with respect to lithium and volatility. Our internal work, we fully agree. It's one of the most volatile of all the minerals, and some of us forget that I think just before COVID, maybe 6 or 7 years ago, one of the largest and best lithium deposits in Quebec, the Nemaska deposit, had all the elements of a great deposit. All the elements, all the big banks came in, all the big financiers, etc. And we know what the story is. So that blew up. And it blew up because lithium prices blew up.
Yeah, exactly.
Yeah.
Just a quick comment. You mentioned pricing. So just as an observation, one of the issues that we have with these new value chain supply chains that have to do with critical minerals, that a lot of the elements, although there's still the elements from Mendeleev's table one way or another, they're consumed as intermediates. So hedging and figure out and the price volatility of them is sort of exponential, and a lot of them don't have terminal markets, or even when they do, like cobalt, it's not really a big enough one. But it's definitely true. Although the CME and the LME are trying to create futures and so on, it's still very difficult from that perspective to stabilize your financial model going forward beyond the normal volatility of commodities that we're all familiar with. Yeah. And from that perspective, a couple of weeks ago, we were in DC and had some meetings with folks from the DOE, from the LPO, et cetera. And they sort of asked, how can we do better? How can we help? And one of the things that came up was that if you enable commercial lending by figuring out where are the things that don't work, which have to do mainly, I suppose, with political risks and with pricing and with price volatility. You don't necessarily need to be the lender of last resort and replace the commercial lending, because if, for example, you could provide a price guarantee to a certain minimum, similar to what commercial companies do in standard offtake agreements, or when we underwrite 70% of the production with a certain number to enable project finance. That's one of the things that you can actually do, and perhaps through that you can have your firepower will become more effective, because ultimately it is, even if you have to allocate for the downside risk, guaranteeing $1 billion loan is still less burdensome on the public budget than actually lending the $1 billion. And there are some of those sort of mechanisms where perhaps governmental support, or maybe even international support through the mechanisms that Hamid is preaching, could perhaps enable the market to flow in a more kind of standardized and normal way within the existing solutions. So that's another thing that sort of came up in that discussion with the U.S. government.
So we're getting quite close on time now. Maybe I thought we could just kind of close out the panel with a quick outlook moving forward from our panelists. So views on kind of the investment, whether kind of there are proper solutions in place to kind of spur more investment into the critical mineral space. Keith?
Yeah, I would say, as we just said, the critical space is quite volatile, but we have to remember the critical minerals. Lithium is just one. Traditional copper is a critical mineral, and in fact, one of the key critical minerals. And the outlook for copper, I think, is very, very, very strong. It's a traditional industrial mineral. So goes the economy, so goes copper. But it has this aspect of the energy transition to it. Nickel, I see nickel, the future for nickel is also an industrial mineral, but also, of course, a critical mineral. Lithium, in fact, just last night, we had a call with Asian a buyer for a project in Argentina, and I'll tell you, there is a lot of buyers still looking at lithium, notwithstanding the price softness right now, because the general consensus is that let's try and buy while the prices are down. And so going forward, I think the future is bright. And of course, we didn't talk about it, but I think maybe this afternoon you'll talk about gold. Gold is just going bonkers. And I said it here, I wouldn't be surprised in the next 2 years seeing 2,800 gold. It's a high possibility.
Sounds great. Any last words from our other panelists? All right, well then, in that case, I want to thank everyone for joining us today.